Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Federal Agricultural Mortgage CORP quarterly report. Federal Agricultural Mortgage Corporation offers a wide range of businesses and services to support agricultural finance in the United States. These include purchasing and retaining eligible loans, guaranteeing loan payments for securities backed by pools of eligible loans, servicing eligible loans, issuing long-term standby purchase commitments for designated eligible loans, purchasing and guaranteeing securities issued by lenders secured by pools of eligible loans, supporting electric or telecommunications facilities through cooperative lending financing rural electric generation, transmission and distribution cooperatives. These services are provided across 7 segments: farm and ranch, corporate ag finance, power and utilities, broadband infrastructure, renewable energy, funding and investments. The stock price of Federal Agricultural Mortgage Corp has dropped by over 15% in the past year due to a combination of factors. The company's underperformance relative to broader markets, such as the S&P 500, has contributed significantly to its decline. Additionally, a decrease in profits and low operating cash flow have raised concerns among investors. The agricultural finance sector is also facing challenges, which has impacted the company's stock price. Furthermore, macroeconomic factors such as interest rates and agricultural commodity prices are affecting the company's performance. Valuation concerns, with shares being 13.5% overvalued as of October 6, 2025, have also contributed to the decline. A slight earnings miss in Q3 2025 was a minor contributor to the overall yearly drop. The primary drivers of revenue growth or decline in a given financial period are multifaceted. On the growth side, key contributors include an increase in net effective spread by $12,373, guarantee and commitment fees rising by $1,135, and a significant boost from government support payments, which saw a 29% increase. Additionally, the infrastructure finance portfolio experienced substantial growth of $0.6 billion. On the decline side, notable factors include a loss on sale of mortgage loan totaling -$1,147 and a decrease in agricultural finance portfolio by $61.4 million. Furthermore, trade policy uncertainty and labor availability issues also negatively impacted revenue. Net income and profit margins. A mixed picture. The net income of a company has shown mixed results over the past year. While it increased by 10.8% for the 3 months ended September 30, 2025, and 6% for the 9 months ended September 30, 2025, it actually decreased by $27,830 for the year 2025 compared to 2024. Furthermore, a decrease of $313,145 was observed in the 3 months ended September 30, 2025. Profit margins have also fluctuated. The net interest income margin increased from 21.1% to 23.8% for the 3 months ended September 30, 2025, but decreased from 24.4% to 22.6% for the 9 months ended September 30, 2025. The reasons behind these changes are varied and not consistently stated across all pages. However, some key drivers include unrealized gains on cash flow hedges, net interest income, losses on financial derivatives, higher interest rates leading to increased interest income, and various factors contributing to an increase in non-interest income. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. The net cash used in operating activities and the negative operating cash flow of $-1,062 million suggest that the company is struggling to cover its expenses and investments from its operational earnings. This trend is concerning and may indicate underlying problems within the business that need to be addressed. The company's debt level has experienced fluctuations over the years. While it decreased from $6,183.5 million to $5,953 million, page 26, there are instances where it increased, such as notes payable rising by +8.1% from $26,759,873 to $28,824,748, page 71. However, the debt level has also decreased significantly in some periods, like from $8.5 billion as of December 31, 2024, to $7.6 billion as of September 30, 2025, page 128. Regarding interest expenses, there is a mix of increases and decreases. Interest expenses have increased due to higher unrealized losses on available-for-sale investment securities, page 26. However, in other instances, total interest expenses have decreased significantly, such as from $1,179,228 to $882,894 for the 9 months ended September 30, 2024 to 2025, 25% decrease, page 95. Overall, while there are some increases in debt level and interest expenses, there are also instances of significant decreases. The company's financial performance varied across different segments and regions. Notably, the renewable energy and broadband infrastructure segments excelled, as did the Northwest and Southwest regions. The crop's commodity/collateral type also performed well. On the other hand, certain areas struggled. Loans on non-accrual and the ethanol loan portfolio underperformed. Agricultural finance mortgage loans in specific geographic regions and those with high original loan-to-value ratios also faced challenges. Additionally, borrowers within a particular exposure range experienced difficulties. The Mid-South, Northeast, and Southeast regions were among the poorly performing areas, although the Southeast's performance was only slightly subpar. Management's outlook on company strategy. According to management, the company is poised for growth in various sectors. Notably, they expect an increase in loan purchase products and other financing solutions due to rising demand. This growth will be driven by opportunities in fiber and broadband-related transactions, as well as investments in technology, infrastructure, and human capital. Management also anticipates a rise in credit demand in agricultural processing and food supply chain sectors if interest rates remain low or loosen. Additionally, they expect to continue participating in renewable energy power project finance transactions despite potential policy uncertainty and higher costs. The company's strong balance sheet, with $5 billion in assets as of December 31, 2024, will enable it to manage institutional credit risk through lender eligibility requirements and monitoring financial condition. Management plans to maintain a stable earnings profile across various interest rate environments by funding asset purchases with debt that has similar duration and convexity characteristics. Overall, management strategy is centered around balancing liquidity risk and refunding/repricing risk while generating stable earnings and capital resources for the foreseeable future. The company has a history of paying dividends to its shareholders. Specifically, it paid a quarterly dividend of $1.50 per share for all classes of common stock in the first 3 quarters of 2025. This demonstrates a commitment to returning value to investors through regular dividend payments. Concerns over inventory buildup and supply chain disruption. The financial summary highlights 2 pressing concerns that warrant attention. Firstly, there is a risk of inventory buildup, which poses significant challenges for businesses. This issue is further exacerbated by the potential for supply chain disruption. The likelihood of both these problems occurring suggests that companies must be proactive in managing their inventory levels and supply chains to mitigate any adverse effects. That concludes the financial summary for Federal Agricultural Mortgage CORP. Feel free to comment below, and I will be happy to answer them when possible.